So if the upside is 100,000 and it's $200, it's the best risk reward any of us will ever come across in our entire lives, and maybe one of the best risk rewards of all time.
Hey guys, welcome back to Library of Wealth. Today we have ex-hedge fund manager Raoul on the current state of the market. Raoul says that this next cycle will be institutions who will misjudge the volatility of the crypto market. He says that everyone who comes into these economic conditions will have to take it on the chin a few times to understand the variability of the space. He says one of the reasons why crypto digital assets have plummeted is because unrestricted spending had emerged from the market. Because market prices rose, people didn't have enough to purchase any dollar cost averaging crypto, which eradicated a massive amount of buying power. Let's listen to this interview with Raoul as he gives his take on the upcoming recession, cryptocurrency, and the flexibility of the market. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
So let me tell you my crypto investments, my Bitcoin investment story, because it highlights it the best. Because I just recently went through the maths of this and I kind of shocked myself. So I first heard about Bitcoin during the European crisis in 2012. I realized that this was a solution to a lot of the global financial system, and I wrote the first macro strategy piece on Bitcoin probably ever published in Global Macro Investor in 2013. And it was driven by a friend of mine, Emil Woods, who's is very well known in the space, and Chad Cascarello, who are Global Macro Investor subscribers, saying, listen, you need to look at Bitcoin. So I looked at it. They happened to have started an exchange called ItBit, which is now Paxos, and I ended up buying Bitcoin. And I stuck a decent size in because my analysis was, it's at $200 now. If I back out the analysis versus the stock to flow of gold, this is worth $1 million with gold at these current prices. Therefore, it's underpriced. I hadn't figured out anything else about network effects, but I kind of understood that this was potentially important. And I assumed that it would go to zero. So my downside was 200. My upside was 999,000, blah, blah, blah. And then I said, I assumed that I am a total idiot, which I try and assume most of the time. And therefore, I'm 90% wrong. So if the upside is 100,000, and it's $200, it's the best risk reward any of us will ever come across in our entire lives, and maybe one of the best risk rewards of all time. So I took that bet, right? Macro thesis, did the work, said this is probably a 10-year play, and I'm going to hold it. So first thing that happens, I put the position on, it goes up 100%. It goes up 100% a month and 500% in the next 4 months. I'm like, holy. I don't sell any because I've got a long-term thesis and it's fresh in my mind. It then falls 85%, but luckily back to my entry level. So it gets back to 200. I don't do anything because I had a long-term thesis. And then I kind of forgot about it. And then 2017, it starts coming to life again and it's starting to scream higher. And now it's at 2,000 or 2,200. And I'm like, okay, I'm up 10x, which is good. My thesis obviously was a lot more, but I'd forgotten that because now the forking wars had started. And I suddenly thought, is this existential? Is this the S-curve moment where it fails? So I sold it. It went up another 10x to 20,000.
Powell believes that to know how the economy is, you need to look within the biggest sectors of the stock market. This means looking into utilities and consumer discretionary stocks. If the economy is failing, this means that discretionary stocks are decreasing, which means we need to prioritize buying and owning as many utilities as possible. Powell has seen that even though business cycle indicators are accurate and more people are studying them over time, they aren't naturally the operator of current price action.
I didn't worry about that because I'd made 10x and it was okay. It was a good trade. And I was worried that it wasn't going to be able to play out my thesis because of these forking wars. And then it fell 85%. I wasn't in it. And eventually I got in April 2020. And I can't remember what my average was. Call it 6,800 or something. And then I'm still long and then, rotated into ETH and did other stuff. But anyway, so great trade. One of the best trade of my life. I went back and looked at, if I just kept my initial investment at $200, I would have done, I can't remember the number, 5 times better. Even though the size that I added in March 2020 was massively larger than the first size
Interesting.
It still didn't work. I'm like, huh. And then I thought, okay, if I'd actually followed my thesis, which is when it gets very oversold, and it gets to that kind of logarithmic, the bottom, the 2 standard deviations oversold of a logarithmic channel or whatever, if I'd actually just doubled my position every time, but not doubled it, sorry, just added the same amount as my initial seed investment, I'd have done like 25x. I'm like, okay. So what I thought was a great trade was actually a terrible trade because I didn't trade my plan and I didn't think about what I was trying to achieve. So that's leads into the question about, okay, the market sell off now. I'm immensely comfortable because I see the network adoption. I've got even more models to understand how this space works. I see how broad and deep the talent, the adoption, the kind of conversations that Greg and I have with people all the time, it's like seeing the future. So therefore, the volatility now, I've been adding as fast as I can, scraping the sofa for coins, anything to put more money in. What's the optical effect that's actually quite hard is once you've had a big gain and it's, even though it's come off a lot, it's still a reasonable amount of money. And you don't have that much capital available to double it up. And it doesn't feel like your position's getting much bigger. And I'm struggling with this right now because, I'm increasing like by 10% or 20% because I don't have the cash to do that. I've got a big picture framework that is robust and tested and is deep. I've done a lot of work on it. So I feel comfortable with the probabilities. Now, I love markets like anybody else. So I've got on my screen the real-time chart of ETH daily, weekly, monthly, and hourly. I don't even trade ETH. I just buy it. But I like the market and I look at the price action. And what I did the whole period was just didn't look at my P&L. So I have learned, and this is a new thing for me, how to disassociate myself with my P&L.
Raoul says that there is a propensity to create persistent inflation until the following business cycle. Every time a cycle comes to an end, inflation increases, but is balanced by recession, which causes prices to decrease. Powell says that the market can move in any direction, but he believes it will move in the shape of a V. This is because he has been studying every market contributor and their pain points. People aren't seizing the opportunities in front of them because they're busy watching tick charts. The long-term players aren't taking the risk rewards available because they are too worried about the rising prices. What do you guys think about Raoul Pal's opinion on the direction of the market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.